Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Roseman, CEO of 1970 Group, to discuss the financing environment and impact of corporate liquidity. Stefan, it's great to have you with us. Welcome to Trade Talks.
It's nice to be here with you, Jill.
All right, you got it. Let's look at the macro environment for a moment here. Would you say that we're back to traditional financing environment and normalized business cycle?
We are indeed. We were lulled into a false sense of security over the years since the credit crisis with a vastly eased financing environment relative to what most folks had experienced in corporate America and also in the lending world. And we are now going back to what I would call a much more normal environment. And by normal, I mean what one would have experienced prior to the credit crisis, prior to 2008.
How is this challenging corporate liquidity?
Well, banks are pulling in their horns as a consequence of a few things. So one, of course, you are well aware of the folks who are signaling that there might be a recession afoot, and if not, then it's coming down the pike in short order. And as a consequence, banks themselves are being challenged to make sure that the loans they're making and the access to capital is for higher quality credits. But secondarily, we had the unwelcome experience of last year's Silicon Valley Bank and the like, and that really left a dent in the market. Now, the corollary to that and the pickup is on the private credit side. So private credit markets have expanded dramatically over the last almost decade. And according to Goldman Sachs, private credit in general is up something on the order of 7x since the credit crisis. So private credit is really taking up a lot of the slack where banks have pulled in their horns. So when you ask what's happening, what does that mean for corporate liquidity? It means that companies are confronted with an environment where they have to be more creative. They have to get in front of it with a higher lead time to make sure they're positioned to refinance maturities if they have maturities coming up. If they're aware of any financing needs away from maturities, the lead time to put the pieces in place for the financing are absolutely extended. And we're seeing it and hearing it every day. 1970 Group serves large corporate America. So we are serving the companies that frankly have varied exposure and different experiences with banks. But I would also say as a cohort, very much center of the fairway as it relates to would-be borrowers.
Well, that's interesting, Stefan, because we have increasingly been reporting on the momentum behind private credit, whether it's from a lending perspective or as an asset class. Do you think the momentum behind private credit is somewhat here to stay and that perhaps it won't go back just to traditional bank lending, or perhaps a combination of the two?
Well, it'll likely be a combination of the two, but to hone in on the first part of your question and really emphasize that part, you nailed it, Jill. Private credit is here to stay. And although it'll be a combination on a go-forward basis, private credit is, by its nature, because it's not part of a normal or regular depository institution, it operates with its own set of rules, and they look for reasons to be able to expand their business. I mean, you can't have a business, an industry expand 7x in the span of, call it 13, 14 years without market participants willing to extend more to borrowers who are willing to borrow more, right? And so as a consequence, that truism means, and there's an expression that I don't love, but it's shadow banking. It is really banking that is done outside of the bank, the regular banking mechanisms, right? And that is not going to go the other direction. The banks have become increasingly, for much of corporate America, just harder to work with when it comes to idiosyncratic needs, when it comes to speed to access to capital, et cetera.
And back to the corporate side for a moment here, how have balance sheets been impacted in the post-COVID era?
Well, so it would depend on which industry we're talking about. In general, I would say that, again, well documented, of course, that there are certain industries that are being more challenged. So, for example, commercial real estate, we understand that, of course, vacancies have been on the rise, that real estate operators have been challenged with that specific exposure on the commercial and the office. You're seeing it in retail as well. But when you talk about balance sheets writ large, it really is going to depend on what industry. So, for example, the energy industry since COVID experienced something of a roller coaster. So going into COVID, the oil and gas markets were at multi-year lows. As a consequence, revenue and cash flows were impacted in a way that had operators in the space seeking out additional sources of liquidity. And you fast forward to a year into COVID, of course, you had the Russia-Ukraine conflict, and oil and gas prices were all of a sudden making, within a span of a number of quarters, 2-3 quarters, were making multi-year highs. And that cash crunch reversed. And that allowed those companies to take on a very different posture, right? So even in the span of within a year, literally within a few quarters, it varied pretty dramatically. So since COVID, it was something I experienced unevenly by different industries. I would say that on balance, it has been harder to access capital. The problem is when you look at the market, it's easy to conflate the post-COVID environment and reference that era with then what happened with Silicon Valley Bank a year ago, which was coming on the heels of that, right? So it's hard to tease apart what is quote unquote COVID related versus what is a systemic failure in a part of banking.
I would agree with you there. It feels as if what happened a year ago with the banks was more idiosyncratic than a symptom of the entire banking system. Would you agree, or am I kind of
that's there? Well, it's absolutely right. So you absolutely nailed it, Jill. However, I would give a pretty bolded asterisk on that comment. The challenge is one could reasonably argue that the reason we saw the built up reaching for incremental yield, reaching for incremental return from banks was because of the eased environment, right? So if you look at global rates, of course, as we know, were near zero, and people were reaching further up on the risk spectrum for return. Now that's investors, that's banks, that is the average investor, the non-institutional investor, so the average household. And so some of that shakeout that came about, of course, Silicon Valley Bank was very specific as it relates to the nature of their exposure, the nature of their balance sheet was constructed, was a result of that low yield environment, right? So while I agree with you that it feels like it's idiosyncratic because the Silicon Valley Bank failure was its own episodic banking crisis, one could reasonably argue, and it's supported by a lot of the data, that banking crisis, the seeds for that banking crisis were sown because of the low rate environment, right? So it's hard to tease that apart.
All right, Stefan, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Good to see you.